What's up guys, how you doing? If you clicked on the video, you probably want to know what are some mistakes that beginners investors make. And by the end of the video, I'm going to go over 5 mistakes that I kind of dealt with when I first started, so hopefully they will help you out. If you're new to the channel, my name is Ethan Chase and I post videos every single weekday of me trading the stock market and weekly videos on personal finance, investing, and life. I started investing back in 2013 as a 13-year-old, and if that sounds crazy, I know. I never thought I would be doing that, but the story is my dad set up a custodian account and started saving money for me, and he wanted to teach me about investing and kind of brought me up as an investor. I'm very proud and fortunate and thankful that he did that, because now, I have methods as a 20-year-old to start building wealth. And it's not like when you start investing, there's some kind of magical power that just gives you all the information. You have to lose a lot in order to learn. You have to lose money in order to eventually make money, because you gotta learn those lessons. But hopefully by watching this video, you'll understand 5 things that I did as a novice that were mistakes, and hopefully you don't do that so you can kind of get ahead and get more experience. Advice number 1 is you need to research the company before you invest in it. And this may sound, very basic, like do your due diligence, but you really need to know the ins and outs of the companies you own. Over the time, when you get money to actually invest, you can kind of get this like investor euphoria or optimism that just because you have money, you want to deploy it and you want to invest, which is awesome. And it's good that you're excited, but you have to be cautious, because you shouldn't just jump into a trade or buy a stock because you have money. You want to research the company, make sure, do they pay a dividend? What has their stock performance been in the last 5 years, in the last 10 years, in the last couple of months? What has happened recently? Are there any headlines out there that, might show that this company isn't a good company to invest in? Overall, many companies do fail and don't succeed over time. So the notion that buy and hold forever, that's ludicrous. Most companies actually don't succeed in the first. A great example is Kodak. Kodak, they used to have their kind of camera, but they themselves invented the digital camera, the very product that ran them out of business. So you got this whole idea that invest and hold forever. Sure, you could hold and invest for a long time, but don't just buy a stock and then not look into it. You need to do your due diligence, you need to do your research, and most importantly, you have to have a thesis, a conviction of why you want to buy the company. Something like this: because this company has this product or has this service or is doing this. Because of that, I believe that they will continue to have success or will have success, and that is why I am choosing to give my money and become a shareholder and invest in their stock. And that's your conviction. So you gotta do your research. And the question is, okay, now I have the stock, what happens if it sells off? Well, you typically don't want to sell unless your core thesis changes. If just the market sells off but your company is still doing their thing, then that's not a reason, in my opinion, to sell the stock. If the market's tanking like crazy and there's a recession, or if there's a broader market force, which I'll discuss later, that could be a reason to switch things up. The second thing, super interesting, and a lot of people, and I myself, I fall prone to all of this, is investing in stocks just because they pay, 1, a dividend, or B, pay a high dividend. And just like anything, if it sounds or it looks too good to be true, it probably is. And the issue with stocks that pay super crazy high dividends is that if you look at their charts, typically, not saying for all, there's never, what's the word? There's never totalities. That's not the word, but that's close enough. Absolutes. There's never absolutes in the stock market, but typically, if you look at their charts, they have a nice downwards trend, which is not what you want to have. You want to invest in stocks whose shares will appreciate over time, and you make money off the appreciation or the increase in value. Obviously, a dividend is nice because it's an additional buffer to the price of the share going down, but just because it pays a crazy dividend is not a reason to invest in it. Usually, the company might be trying to hide something, or it just might be kind of desperate for people to buy their stock and have demand in their stock. So you gotta be careful. This goes back to rule number 1. Research your companies. Know what you're investing in. One of my favorite things to do is because for me, I'm a very contextual and visual person, right? So if I want to know what a company does, let's say, I don't know, let's say there's a painting in my room. Let's say they make paintings or they create some sort of material for paintings. Well, that's cool, but for me, I need to see, I need to interact, I need to feel the product or the service. So an awesome thing to do is watch commercials. I feel like no one does this. I'll Google the company on YouTube and see what commercials they have. Go on their website. Who runs the company? What are the employees like? Watch a commercial. I think commercials are super cool because you get to see the company you're a potential owner or a partial owner of in action. So do your research, and if something's too good to be true, it probably is. So just be careful. And what you need to know, wow, this video is crazy gems in it. What you need to know is for every trade you're taking, so for every time you think a stock will rise, in order to get that share, someone has to sell it to you. So someone has to think the opposite. Either they don't think it's going to keep going up over time, maybe they just want to lock in profits and get more money. But for every trade you take, there's someone on the opposite side who has the opposite view potentially. So it might be annoying it might be annoying to think about that and question, really, am I wrong or what am I missing here? But that's kind of the beauty of the game of investing, is that you need to ask yourself, you have to run through all the scenarios. What if I'm missing something? What if my initial thesis and idea is wrong? What if the person selling the stock to me is actually right? And what if I shouldn't invest? And those are powerful questions, but those are the questions you need to ask yourself. If you're liking and enjoying the video so far, take 2 seconds to hit the like button so the YouTube algorithm will pick it up and suggest it to others. And please subscribe to the channel. It means a lot to me, and I do this all for free and out of my time, and all I ask in return is for you to do that, because it truly is another step in my journey to financial freedom. Number 3, and this is kind of in tandem with researching the company, but also as important is researching the sector or the industry that your company is in, but also the broader market. What's going on in the world? What's happening, globally? Because global events impact the entire market, and if that impact is big enough, regardless of how your company's doing, your company may suffer. This is what happened with the pandemic, right? When there's a global pandemic and everything goes into shutdown, fear ensues and everything sells off. So even if your company is still doing an amazing job, because there's wider fear in the market, your company's share price will go down. So you need to understand kind of the dynamics of the industry. So this is a further extension of your thesis and of your company researches, researching the sector, the industry, and the general global kind of market. How's the economy doing? Are we in a recession? Are we flourishing? Is it a golden age? Is there issues of trade wars? Is there issues of viruses? Stuff like that. It's important to understand what's going on. Now, you don't need to be, head deep in papers all day reading everything, but just have a good sense of what's going on. You gotta understand where your company fits in the industry. How are its competitors doing? Who are its competitors? What are their competitive advantages? Everything you learn in school and in life and in college and really everything, it all works its way back into the stock market, which is why it's so cool. Number 4, and kind of what you probably hear all the time, but you never know, or what you hear all the time, but you probably don't do, something I didn't do, something I still don't do sometimes, is having a clear, definitive stop loss. And what's a stop loss? Well, let's say you buy a stock at $70 and you tell yourself, I will sell the stock no matter what if it goes below 45. Let's say in a couple of years it goes below 45 and you're still holding the stock. Well, right now, when you don't actually have money in the game, you're like, nah, I'm gonna sell it. There's no way I wouldn't let myself sell it. I can handle my emotions. I'm better than that. But the truth is you're not. Once you have money invested and your ego takes over, there's nothing stopping that. So the only way to learn is by making that mistake. And honestly, I'm a big believer. In order to make money investing, you have to lose some money, because that's the only way you learn. You know, there's a difference between understanding the ego and the stop loss and emotions. There's, you know, intellectual understanding, but then there's the experience and the kind of real experience and understanding of it. That's what makes you better. I'm not telling you just to go waste a bunch of money and lose a bunch of money to learn, but it's going to happen inevitably over time. There's no way really of beating that. Even the best investors lose money on bets. So that's the point of the stock market, is risk management. You will lose, but if you do it correctly, the gains from your winners will be greater than the losses from your losers. So having a clearly defined stop loss is super important, because it cuts through all the emotions, it cuts through all the ego, it cuts through all the BS. No matter what, you could just get out. There's a few ways to do that. On the brokerage account, you could set a stop loss limit, so no matter what happens, it sells. Of course, your ego may want to go and cancel that. If it gets, let's say your stop is $45 and you see the stock's at 46, your ego might pop in and you might go to cancel that order. But you got to have a clear, defined stop loss, because the biggest question, what if you're wrong? What if what you thought was going to happen isn't what actually happened? And, you know, you can tell yourself, no, okay, I can handle my emotions. I know if I'm wrong, I'm going to cut my losses. But, you know, look at the statistics. Most people don't. Most people let their losses bleed and bleed and bleed, and they don't nip it in the bud, and they lose a lot of money. So having a stop loss is critical. Just recently, I was trading a stock, and, you know, it went below my stop loss, and I told myself, well, my core thesis and my core idea of the stock hasn't changed, so let me hold it. Well, it kept selling off, and I finally cut my losses, and thank God I did, because the stock got pummeled even more. So I would have lost way more money, but because I kind of, you know, I took the defeat, I took the loss, I sucked it up, whatever, it helps you in the long run. So that's step number 4. Number 5, take profits off the table. And this goes in hand with the stop loss, but this is interesting, because the kind of investing principle is, you know, cut your losses and let your winners run. But in hindsight, you only know if your winners are winners, and if they run is when in hindsight. In the moment, if you're up 5-10% on a stock, you then have the question, do I lock in the 5-10%? Do I sell some of my position and keep a little bit left? Or do I just let go? Can I get 15% return? Can I get a 20% return? Now again, you can tell yourself, I can handle my emotions, I won't let greed in my way, but I'm telling you, they creep up, the emotions will get to you. And I myself been victim to this a lot, I'm greedy, I want that extra percent. I want that home run. And what happens when you kind of swing for home runs? You strike out miserably. So let's say you're up 6% right now on a stock, and you get that question, should I hold? Should I sell some? What should I do? What I have found, and just in my experience, by locking in the profit, you will net the highest percentage possible. If you let it run, most likely it'll come back down. You'll lose money. So instead of having 6%, maybe you lock in 4%. You lost out on that 2%. Maybe it runs, but, you know, and of course, this is the art of investing. This is where intuition and luck to a certain extent, but this is the intangible of investing, is that decision in real time. You don't know the future. You have some money. You have some money on the table. Do you lock it in? And not to be a buzzkill, there is no right or, I can't look. I have no idea. Sometimes you're right, sometimes you're wrong. What I have found is it's always good to kind of take money off the table, secure it, lock it in, so no one can take it away. It can't go down in value, and it's yours forever. Alright guys, that is it for the video. I hope you enjoyed all of the information I gave you. If you did at all, hit the like button. It means a lot. The YouTube algorithm will pick up on it and recommend it to others. Comment down below if you've had an experience with the 5 mistakes I made, and let me know a story behind it, like what happened. And of course, subscribe to the channel, because really for me, every subscription is another step on my journey to financial freedom, and it motivates me to make these awesome videos for you.
you.